Hey traders, welcome to Charts and Coffee. Great to see everybody. Happy Thursday, everyone. Um, Ready to caffeinate and dominate. As always, we're going to take a look at what's going on with the markets as we kick off the trading session. So let's see, what could this market be having to process today? Of course, the ongoing variant concerns. By the way, yes, is there a high likelihood that this will be faded? I think there was a comment on either the free video or maybe yesterday's Charts and Coffee where someone said, why is the market panicking? We've seen this before. We've recovered before. Yes, but of course, remember, a new narrative always has to be discounted. Remember, the markets are a discounting machine. What do we think could happen? And let's prepare for that. Then again, what actually did happen? And did we guess right? Right? That's the process of buy the rumor, sell the news, or however that preparation factors into the market. All right. So then we've got that. Then we have this on again, off again federal government shutdown. I hear that's kind of a thing. All right. So then there's that looming over the market. Remember Pigpen from the Peanuts, Charlie Brown and the Peanuts? Well, this market is like Pigpen. Pigpen seemed like a nice enough guy, went on his way, but everywhere he went, just a dust cloud and that cloud hanging over the poor guy. It's kind of this market right now. And then the third thing is we have an honest to goodness taper tantrum. Why? Because we knew taper was coming. I'll give Powell plenty of credit. We knew this was coming. He's projected it quite well. All the credit in the world for narrating that in a far better way than, say, the Bernanke did. But now with we're already accelerating towards taperdom, and he just floored it, right? He just said, we're going to do this quicker. He just dropped the hammer on that timeline, truncating it, which means he's also brought the eventual rate hikes closer into view. Those are all things the market is going to hate. Okay. And that's just where we are. So there's a lot of things to think about in terms of December. And one of the things that we're doing, and I'm finding myself doing more and more, at least it's the shiny part of my book, is the shorter term narrative, shortening the time frame, shortening the time horizon, and in many ways just day trading. So that's how we're dealing with this right now. We've had a very busy calendar. And is Thursday any exception? No. Just when we thought we had the FOMC chuckleheads behind us, after 2 days of testimony from Powell and Yellen, we've got Bostic, we've got Quarles, Barkin. Bostic's twice. My gosh. Daily. And then we have OPEC meetings, which are definitely going to affect crude oil. Is OPEC going to say, oh, you want to release your strategic petroleum reserves? 3, 4, 5 countries? Great. We're going to decrease production. We'll see what the messaging from OPEC is. All right. So that's what we've got. It is not a boring beginning to December. So let's dive into your questions. As always, thanks for being here. Love the questions. And let's do it. First thing first, ES and NQ. So, Stephen, ES, I will say, and this is pretty much going to echo what I talked about in the free video and in the premium videos last night for Wednesday. And that is, I'm going to stay away from ES right now because of XLF and XLV. Sectors are going to give you an idea as to which corners of the market are going to be benefiting in a way that's specific to a much more niche group of stocks. In other words, when I look at QQQ, it's a lot of different tech names. I'm not a big fan of looking at, for example, FANG as a group, because when we know that QQQ has all the Fs and the double A's and the G's, right? We know how that goes. They're important, don't get me wrong. But what we know is that the disproportionate weighting of stocks within the index and within the sector actually elicits completely different behavior. I'll tell you what, considering the carnage of really the last couple of sessions this week, XLK is remarkably resilient. I thought SMH was as well. And why would I say that? No yellow JT multi, no blue grab candles. We haven't even touched the 21 exponential on SMH. So I guess my first bit is let's steer away from ES for now. XLV and XLF are just not looking like they're able to do their part for me to keep ES a bullish narrative. NQ looks far better, but rather than look at NQ again as a whole, let's get more specific. And that's where those sectors that I mentioned will definitely come into play. I think in a better way for us to find the corner of the market that's been more resilient. So great questions. Thank you so much. Next up is Darren asked about Amazon. So Amazon takes us back to that similar conversation. Are there certain stocks and corners of the market that we like better? I think the statement I like better finished by Amazon has not happened at all this year. And you take a look, gosh, take a look at this chart. Don't look directly at it for fear of it just might make you seasick. It's an ugly chart. It's had a lot of resilience above the 200 exponential. So if there is an edge, and it's a soft one at that, that 200 has been, I can't say good, but it's been a good place to build a position in Amazon looking for further upside. And I wouldn't doubt that that could happen again. But I will tell you, I'm not a big fan of Amazon. I'm slightly more a fan of XLY, but that then brings up Tesla. There we go. That then brings up Tesla. Right. What a difference if you go TLSA, and I'm going to die on a hill of typos. I know that. But you go TLSA, whoa, what is that? Anyways, you got to take a look at Tesla. Take a look at this. This is a relative outperformer from a boats and tide perspective. This boat, love it, love it. The tide could be tricky. This boat, not so much, right? But if you think Tesla and Amazon and potentially the Home Depot could move higher, I would keep an eye on XLY because those are your top 3 weighted names. All right, so moving on to the next question. I got a technical one. Hey there, Jim. When do I change my VWAP anchor? So there's 2 or 3 on the end of day charts. First of the year, I've got my yearly, my monthly, and a 10. So the 10 has to be updated every day. And I will re-anchor for a December anchor on, I'll tell you right now, specifically Monday. I'll re-anchor on Monday. So there's no sense in re-anchoring for December on December 1 or whatever the first trading day of the month ultimately is, because you don't have enough data to really even populate the VWAP. So I would usually wait 4 or 5 trading days before I re-anchor. So you're still looking at the November on this chart. And then come Monday, when we're joining up for charts and coffee, you'll see I'll be re-anchoring it to, I'll be anchoring it to December 1, but I'll do it on December 6. All right. So, and a lot of you who've taken my submarket sonar class or any of the classes where we emphasize the importance of volume, riding shotgun with price, we use anchored volume studies, never rolling, never the rolling variety. Okay, next up is, let's see, good morning, everybody. No, I appreciate that. Thank you. Netflix. You know how many times I've looked at GM? Because GM and good morning. Yeah. So there was a brief period of time early on in charts and coffee. We've been doing this now for a whole year. November, or was it October, was the 1-year anniversary of caffeinating and dominating. And I think early on I'd pull GM up all the time because it didn't dawn on me, oh, that's good morning. I remember telling my husband, I said, wow, people are really interested in General Motors. All right, Netflix. There are so many corners of this market that to me don't make sense. Gold, don't get it. Why would it be moving in the direction it's moving? Bond yields, in the wake of what's been happening with the taper narrative, makes so little sense to me. My cat apparently wants to get into the office. My gosh, dude. Hang on a minute. Netflix moving lower in the wake of of another variant. Usually that should be bullish to Netflix. So I'm sure there are other narratives. Of course, there are other narratives, and it just seems right now if tech is resilient at the moment, and let's face it, it has been, and Netflix hasn't been, that type of disconnect. Thanks, Bubba. That type of disconnect, you were causing quite a ruckus there, dude. That kind of disconnect is really for me a warning. And so when I think about the stock exposure for Netflix, I mean we can think about the individual sectors that'll be in play, the sector ETFs, but I would be very very cautious with Netflix right now because that's not the kind of. I mean, what happened? Everyone stopped watching Squid Game or whatever. I haven't seen that yet. Is that good? I don't know, but yeah, I look at Netflix and I think about XLC, and I gotta wonder, if you take a look at XLC being drugged lower by IYZ, the telecommunications, you wonder how much that could impact ultimately Netflix. Because remember, boats and tide, even though Netflix might be a great narrative, if that passive investing universe is saying tide is going out, that is pressure on the stock. So be careful on that one. And I hope that explains why. What is the opposite of diamond hands? That's a good question. What's soft? I don't know. Chalk hands? Silly putty hands? I don't know. What's the opposite? Yeah, I would have to find something really soft. Cotton ball hands? Yeah, I don't know. All right, gold. G. So let's start with the GC. Sure. Uh, I would love to buy gold. I don't have it set up. So that's going to then look, if I don't like gold, and Austin, thank you for the question. If I'm not ready to play gold futures, well, that's not going to lead then me interested in micro gold or even the GLD ETF. Everything is going to start with the touchstone of gold futures. And if I'm not ready to play gold futures or gold, I'm not going to play stocks that are going to set up and move in tandem with, or at least be influenced by the commodity. So GDX, NUGT, GDXJ, that's a no. Now, VALE, you threw that in there. That's a cool, uh, that's a cool question because when you think about VALE, it's funny. I don't think gold when I think VALE. I think actually first steel. VALE is about 13% of the SLX. Then I start thinking about, is VALE a relative outperformer? And it's not. So be very careful. I know there's a lot. So this double red is a really good opportunity to remind everybody. And I was talking to the folks in my mastery yesterday about this, and I want to mention it to you all too. December, generally speaking, is not the time to go bargain hunting, bottom picking. It's not the time to think about rotation benefiting weaker corners of the market. It's actually the opposite because window dressing is, think about how many times have you walked by a window at the mall or wherever, and you see a really cool whatever in the window. It's a shirt, a pair of pants, a dress, whatever. And you go inside and you can't find it anywhere. They just put their best stuff out front to make you walk in. That's the same connotation with window dressing as it applies to the end of the year. So let's just put the best stuff in the window. That means that we're going to buy strength. We're going to dump weakness. So sector rotation, it does not benefit, or at least December is not a month of sector rotation almost ever. It's a month of window dressing. And that means the sector rotation, the bargain hunting is going to really start to ramp up in January. So there's a couple specific scans that I like to look at to capitalize on really early Q1 rotation. So if you're looking at a double red, my advice and what I like to do, put it in your pocket, put it in your trading journal, put it on your wish list and just say to yourself, all right, if I like VLE, but don't look at it until January. Okay. So, because this is not the environment, December is not the environment where someone who's managing a portfolio is going to say, gosh, I need to add VLE, which is heading lower into my portfolio because Very few people are going to look at their portfolio on the at the end of the year and say, "Oh, thankfully I've got VALE there." No, they're gonna look. Tesla's probably going to benefit a lot from window dressing because who doesn't want to look at their end of year statement and say, "Oh, I've got Tesla." They may not be keen on where they bought it. They may not even be aware of where they bought it, but people are going to want to see that they own strength and that they don't own weakness. That's what window dressing really is. Hope that makes sense. All right, so with the VIX so high, options will be expensive. How does it impact my call buying? So, Mark, yeah, I mean, look, as far as the VIX um, being high or what, at the end of the day, yeah, here we go. Here's your VIX. At the end of the day, what's really interesting about the VIX, and I'll tell you what, this kills me because some of you in the mastery know we bought this. And I was thinking, yeah, maybe it might be time to do this again because a lot of this is actually rollover that you're seeing when you see that sudden move. But this is rollover and then honest to goodness sell off and so forth. That's been a great move in the VIX. There aren't a lot of calls that I'm buying right now. There's a lot that I would like to buy, Mark, but I will say that when you're waiting for dips and you're focusing on the best kind of uptrends, if you're doing that, your watch list and your activity is naturally going to expand and contract with the way that the markets are moving. So for me, that means I'm just not seeing as many opportunities in trending markets. There are a few symbols that are testing their 200 propulsion. That's interesting. And they're selling off. But remember, generally speaking, aside from implied volatility and volatility factors increasing premium, generally speaking, if you're buying a call on bearish momentum down near support, it's inherently going to be far cheaper than buying it when it's up, which is why I'm a fan of buying the dip and not buying the bounce. So that little bit of momentum makes a huge difference for me. All right, so next up is yeah, is the floor in for CL? No. No. Do I want to buy dips in Tesla, Eric? Yes. I did write 3 books, Bob. You can just search me on Amazon and find them. But I'll tell you what, I wrote those a long time ago, and you're going to get probably far more recent and better information from over at countdowntrader.com. So yeah, the books are out there, but I'll tell you what, don't worry about them. I wouldn't, if you have them, great. They're cool. But if you want to start off with content that's up to speed and fresh out of the oven, yeah, go check out what Trish and I are doing over at Countdown Trader. She has curated sort of the greatest hits in terms of what I think will help a lot of traders new to my style understand what I'm doing it, why, and a lot of the processes behind my analysis. So yeah, I wrote 3 actually. I had a 3-book deal with Wiley. Sometimes I think I'll write a 4th, but I don't know yet. As far as wheat goes, wheat was quite resilient for some time. It's the best. It might be the only grain moving higher. So it is by the dippable. But when you look at the rest of the grains, corn and beans, bean meal, bean oil, they're all fairly choppy, ugly. Corn might be my second favorite grain, but 1K, yeah, it's buyable. It's buyable. What about the Russell? Yeah, so what about small cap? There's an interesting phenomenon that happens, and this is a tendency. This is not a trade, but it does influence why I'm still bullish the Russell. First of all, the Russell's in chop. It's not in a trend. And it's been doing this back and forth all year long, pretty much. There is an interesting phenomenon where tax loss harvesting does benefit the Russell. There's an interesting phenomenon where a strong dollar, it doesn't create, it's not as if strong dollar immediately gets people buying the Russell, but Russell stocks, small cap stocks start looking a lot more favorable to stocks. It starts looking a lot more favorable in a strong dollar environment. So there are a few things that I like in terms of not just this time of year, but also the dollar. But yeah, the Russell got rocked yesterday, and so did KRE for that matter too. I'm not happy about it being south of the 200. The previous dips, we bought a lot of dips in Russell. I shouldn't call them even dips. That's wrong. We've bought bounces off the 200, bounces off the Darvis. This is the first time we've broken the 200. So that does not make me happy. But I also know yesterday was a culmination of three, again, major factors that we talked about here on the onset of Charts and Coffee that might have just been, I know I'm going to say something crazy and you don't have to believe it, but when I see these kinds of candles in succession, I don't see the beginning of a downtrend. I see capitulation. Who knows? Doesn't matter what I see. We trade what we see. I can think all sorts of things, but we need to see proof in terms of our indicators and price and volume, etc., for it to become a trade. But there's a part of my brain that says, "Wrong. This looks like capitulation." We'll see. All right. Okay, gang. Thanks as always for being a part of Charts and Coffee. I'll be heading off into the futures room and the day trading room. I'll be seeing you all in the simpler day trading room here in just a moment. All right, gang. Thanks as always. And I'll see you all mañana. All right. Be good to each other.